Guys, so it's day 4, and on today's topic we'll be talking about key levels, support and resistance. So that's what we'll be treating in this video. So without wasting much time, let's get right into the video. All right, so support and resistance and key levels, right? We've talked about trends, we've talked about market structure, we've talked about multi-time frame analysis, how to combine all of these to get a particular trade idea in the market. Now, on today's topic, we'll be talking about key levels, support and resistance. All right. So, though there are several key levels I look out for when watching for areas price will come to and react from. All right. But on this particular video, I want to talk about them on like different videos. I don't want to like put everything in one video. So we're coming to the second part is POI, point of interest selection. So we'll be talking about that topic in a later class. So, all right. So, but for this class, we are focusing on just support and resistance. All right. Now, we've talked about structure, and we already know that market moves in 3 phases. We have the impulse that breaks structure, then we'll have the correction, and after this correction, market makes another impulse, which is a continuation, right? Now, we have impulse, and this impulse that breaks structure must happen in a particular direction. If price breaks structure to the upside, that means we must have been in a previous uptrend, right? So that means this market is following a particular trend, and that's why we'll have to wait for market to break structure to the upside, then correct before we start looking for trade idea or our entries, all right, to join the market. Now, we've talked about impulse phase, which is pretty much easy because you just have to like break structure to give you that indication that okay, we are in this direction. And aside that, you've already established your bias from the trend. All right, we've already talked about marking our trend, how to know the particular trend the market is in. So you already, before you start spotting your impulse with the current structure, you must have known your direction already. All right. So impulse, then the correction. So the correction is where we have a little bit of problem because the correction happens in different ways. All right. Sometimes we'll have corrections that are like very, very long. It takes time. Like they pull very like deeper into discount levels. Right. Now, when we're talking about swing structures, we said that once we make that impulse that break structure, it confirms our swing low. All right, the lowest point that engineered that break of structure becomes our swing low. In this case, which we this low. So if we're trading, we have to mark our swing low this way. That means price is not going below this level because it's protected because it has also broken structure. Now, for us to mark our swing high, we said it has to change character or give us a sign of reversal here that it wants to start correcting, then we can actually mark that high as our swing high. Now, this impulse that corrects to discounts, right? That corrects to discounts, we don't know where it's going to stop, all right? Some people it's not something that you guess. You don't know if the impulse is going to do something like this. Like after we have our impulse that breaks structure, we're just gonna have a minor correction that retests this previous level that will break structure and start going, or we have something like this. Market gives an impulse, then you know gives us a deeper pullback before moving, or it gives us something like this, breaks, all right, then move something like about 60% of the whole swing structure before moving. All right, so we don't know where the correction stops. All right, we don't know where this correction is going to stop before market will change character or give us signs that it wants to start reversing back to the original trend. Now, that's where key levels comes in. Now, what are key levels? Key levels are specific areas in the market where when price comes to those areas, there is always a reaction. So I'm going to just call them support and resistance. All right. So we use areas of support and areas of resistance to actually, you know, mark out these key levels properly. Now, what is support? Support is basically price doing this, right? In the market. Now look at this structure I marked. If you notice something, you see that we have a high here. So this was where sellers came previously and sold. All right. The moment price broke above it, Now, for buyers to continue buying this market, they use that previous area that the seller sold from to buy. All right. So this is like this resistance and this particular area of price resisted price or prevented price from going above it, and that was where sellers took over the buyers and sold price all the way to this point. All right. Now, when the buyers regained control and they were able to, take out all the sellers here, they came back to that same level where the sellers engaged previously and started buying. So this is basic rule of support and resistance. Resistance will always flip to support when invalidated or when broken, and support will always flip to resistance when invalidated or broken. So I want you to get that in your head now. Now that this was previous resistance, we invalidated it. That means breaking it. Then price has to come back to that zone to use it as support. Now price moved. You can see something. So I want you to like notice the patterns because market moves in pattern. Look at same thing that happened here again. After the sellers engaged there, price invalidated it, came back to that same level and regained it, used it to like buy, push price up. You can see when price came there again. This is just a textbook example. When we go to the real life chart, real life chart, yes. So we're going to see a much more clearer example. But what I'm showing is a typical example of how it happens in the market. You can see price coming to that place. There's always a reaction to tell you that these key levels have orders, right? Which is the reason why when price comes to those areas, there's always some type of reaction and whatever. All right. You can see this level. Price has reacted off of this level previously. You can see resisted price, supported price. Now price came back to that level instead of breaking it impulsively. It kind of reacted, but a little bit, just that the selling pressure was high. It seems like here we've already switched to a downtrend, and that was why reacted but for a little bit and went ahead to break it. Now in this case, if price was to continue in this direction of downtrend, this is what we are likely to get. Price coming back to this area where it has previously supported price. All right. Now that price has invalidated it, we have to sell. Use this previous area that have supported price as resistance to sell. So when I have areas like this, all right, I call them key levels. And when I'm looking at my impulse, correction, and continuation, when I have the impulse already confirmed and I've confirmed my swing structure, which is the swing low and the swing high, once I'm waiting for this correction, all right, and I don't just guess any levels on the impulse side for price to react from. I look out for areas or levels that have these key support and resistance. All right, those are the areas that once I'm watching this correction, I want price to come to areas like this and start giving me reaction. And technically, for this correction to be over, it has to come to some point, and uh, areas that it comes to, and to give us that change of character. Because let's say if this correction is a substructure, right? We said is a minor downtrend in an overall uptrend. Let's say market is making high, low, high, low, high, low, high, low, high. All right. So this is market still pulling back on the impulse leg, right? On the impulse leg. So we don't know where it's going to stop. But with key levels, we can mark out specific areas where we'll be anticipating price to come to. And once price comes to that zone and gives us a change of character, let's say we were protecting these highs, you can see market keeps going lower without breaking the previous highs. All right. So the moment we mark out our key levels and price comes there and give us a break of structure, this is a change of character for us. Meanwhile, this is not a confirmation to actually get in this market. But before we have this break, you must have seen a minor downtrend here, and a minor uptrend here that is going to confirm this structure. And once price comes for continuation, then you can look out for your entry criteria to continue buying till we take out the new high that was created. So that's basically what it is all about. All right. So we're going to go to the real chart example and see some of the examples. All right. This is the gold chart and this is on the weekly time frame. So I'm gonna go to the 4 hour, work with the 4 hour, 1 hour time frame so we can see more structures. All right. So this is like the current structure we have. I've used this example a lot. I've used it a lot, but We can still use it. Go back in time and make use of other example. But let's look at this one. Right, price dropped, and let's see, we have a low already made here. We have a low made here. Price went ahead to make a high. We made a higher low. Price made a new high. You can see the impulse now broke. Right, now price correcting back to this level. Where are we at anticipating price to come back to? If you go to the 1 hour time frame, you're going to see that where price reacted from was actually a key level. Now look at this. I want you to look at this. Now look at this key level. You can see when price was dropping from this zone, it came to this place and stopped. You can see there were some buyers there that pushed price up before we finally broke it. Right, now when price came back above, you can see it invalidated this level that served previously as support for some buyers here. All right, and the moment we invalidated it and broke above it, you can see that price came to that zone again and it supported it. So this is like a previous support level. Price invalidated it, came back, used it as support again, right? And now we've had like an impulse, a new structure. Now that price has started to correct, look at where it came back to react again. That same previous level that have served previously as support, you can see. So this is the only time we can call this a key level. So if we should draw this back to previous price, you can see that the reason why it's called a key level is because like previous past price action has occurred at that particular level. All right, now this is like this happened recently, right? This price action happened around March, 23rd of March to 26th of March. Then going back in time, you can see that 29th of December and between 29th of December to 2nd of January 2026, price also came to that particular level and gave us a reaction. You can see here a supported price, broke above it, broke below it, came above and used that same level as support again to go above. Now, if we were to even draw it back further, you can see that that same level has actually served as resistance for price. Price came here, stored, sold. So you can see price was just literally selling all through here till we broke above. So here it was serving as resistance, here it served as support. Now on the our current price level, it has served as support. Now if we have our structure like this, impulse, we don't have to guess where the correction is going to stop, right? All we have to do is look for areas, key level areas, we mark them and wait for what price to come there. Once price comes there and give us a change of character, then that's our signal to like buy, right? So you can see here after we had our impulse, price corrected, all right, price corrected and came here. Now this would have been our signal because this was low, this was high. We have a low here, we have another high, price broke it, low, high, price broke it, low, high, price broke it. Right, then we made a new low. Price made a new high here, made a higher low, broke it, made a new high, made a higher low, broke it. This is a minor uptrend, but this is where we're gonna break to confirm this change of character. What happened? Price broke above it. We're making high, low, high, lower low, lower high, lower low, lower high. Then here price finally broke this protected point because this lows has been like protected. Price broke above it, which signifies what change of character. And where's the look at this level now? We made this high, price has already corrected. This is impulse here. This is impulse correction, another impulse correction, another impulse. All we have to do is what? Wait for correction, then we buy. Sorry, right? Then we buy from here. So let me clean all of this and make it clearer. Now, don't forget our key level from here. Don't forget our key level from here, right? We can still use that same key level to buy from here. Look at the moment we broke above here, right? We broke above there at our change of character. We've already had impulse correction, impulse correction, impulse. So on this structure now, we have a new impulse that broke structure. So all we have to wait is for correction. On this particular leg now, where is the key level here? You can see that this particular level has served as support. Now price came there and reacted. So if you are taking your entry here, your stop loss below the support level, and you target this high, which is our um next targets, where price is supposed to, next resistance level where price is supposed to come to. You would have hit this about 1:6 RR trade. You see. Now look at another impulse here on the higher time frame. Let me clean all of this. So look at this more example, then we'll call it a wrap. Now look at this. We have this impulse, right? Then we'll have our correction, right? Now we'll have another impulse here. Now look at the correction. Now I want you to notice something. If you check on this impulse, we had a deeper pullback to almost the extreme level before we can get that reaction to continue again. But look at on this impulse now, on this particular impulse here, we did not get that deep retracement to the extreme level. Look at where price stopped. See, look at where price stopped here. Why? Because we don't have to, we can't predict where the market is going to stop. All right, we can't always predict that because this one got to the extreme. This every correction has to get to the extreme. No, we just have to pay attention to key levels. Key levels is what is going to tell us that, oh, market is going to stop here. All right, we just have to, once we've had our impulse, all right, and we've had the signal that market is about to start correcting. So these are our impulse now. The break of this high now is an indication that market is about to start correcting. All we have to do is mark our key levels. Now, where's the first key level here? The most recent key level here we can see is this, right? Look at this, is this one here. Now, look at here, we supported price, right? Even price, when price broke below here, it kind of served as resistance that pushed price down. When we came here, price, this was where price even started selling in the previous structure, right? When price came here again, hit CP, you can see we sold a little bit to show you that there are sellers here as well. So this particular level has been acting as resistance. It also acted as support here because it pushed price up to this level. Now that we've broken above it, this particular area now is a key level because it has acted as both support and resistance. So are you getting it now? So this was exactly, if I had marked at this level, now we've had our impulse that broke structure. Now where is the correction going to stop? We don't know, but these are our key level. So wait for price to come here, and the moment price comes here, we start looking for what? We start looking for change of character, the signal to that, okay, he wants to buy from here and he doesn't want to go any lower. Right, so this is it. First of all, we had there, we respected it, price pushed up, so we have to pay attention to that impulse and correction. See, after the correction, price pulled back to a key level, give us this impulsive candle. Then you can see we corrected, got another leg, another impulse that broke structure. Right, what the market do? Corrected again, gave us another impulse that broke structure. What did he do? Correct again, before we had this huge impulse that actually broke structure and finally breaking this one here. But where did market react? From a key level, support and resistance. Do you get now? So that is basically how it works. Now look at this again. Look at this. After markets made this correction, look at how we made another new impulse breaking structure. What did market do? We came back to correct. So where did we correct from? Look at now. Look, for instance, see where we corrected from, this level. Now, what is familiar? What can you say about this level? What can you see here? This level is actually very clean key level because it has areas of support and resistance. Here, we supported price, we resisted price, we resisted price. You can see here stored price. All the times price came here, and mind you, it doesn't have to be clean. All right, that's candlestick for you. It doesn't have to look so clean. You can see some of the candles are even having wicks above them. That's why support and resistance is not just a straight line. You can't use a single line. All right, you have to use like a box so that the highs and the lows will be touching. All right, you see what I how I'm marking it now. So using a box will give you that idea that it is a zone and not a single line. I see some people using single line like this. So mark their support and resistance. They will use single line like this. It might not be accurate, but using a box kind of joins or you know joins all the heads and everything. All right, it gives you a clearer picture that this is a zone. You wait for price to come into it, then you start looking for opportunities to continue the trend. Here we supported price, here we resisted, and finally price came back to that zone again. You can see how we respected it. Price made a very huge impulse, then we corrected, another impulse correction, another impulse again. See, we finally took out this high. All right, so we're going to come to the class where I have to tell you that where I have to like teach you how to, if price comes to your key level, how you can start looking for confirmations to actually you know get in a trade, or execute your trade, like confirmations that you're supposed to get, and so that you confirmations that you're supposed to get that will give you the indication that okay, he wants to respect this key level and start buying. All right, and that's it. Currently, this is where we are, and I believe with these few examples, you already understand key levels, support, and resistance, and how they actually play a role in the three-phase movement of the market: impulse, correction, continuation. Where impulse, you already know that impulse, you don't have to start predicting where the impulse is going to stop. All you need to do is wait, mark your key levels, wait for price to come to the key levels, then you look for your change of character or your confirmation to actually get in a trade. All right, or not get in a trade, because if it gives you confirmation, you get in the trade. If it doesn't, you have to wait for more confirmation, or you just stay out of the market. All right, so that will be all for this class, and I will see you guys in day 5.